and housing market downturn. It's also relevant to discussions now about ways to structure the mortgage market and mortgage contracts to maybe mitigate the risk of the recurrence of what happened. So our first paper looks at the situation during the boom years preceding the crisis. It's entitled Subprime Mortgage Affordability and Origination Volume During the Boom Years. It's co-authored by Andrew Davidson, Alex Levin, and Susan Wachter.
Good afternoon. I guess still morning. Good morning. Thank you very much to the organizers for having us here. Our talk, at least for me and Alex, is not subject to the usual disclaimer. Our opinions are, at least for me, both the opinions of myself and my firm. So this work we did with Andre Pavlov and Susan Wachter. We were looking at the subprime mortgage market and looking at sort of the boom in lending and trying to understand better. And really the whole paper is summed up in the subtitle, People Eat More If Food is Cheap. Those who eat cheap food get sick. So that's basically what we'll be showing. So the subject of the study is the link between aggressive lending that we believe was underpriced and what happens to real estate values. There's been several papers in this area already showing the link between subprime pricing and the share of subprime mortgages and how that affected price appreciation during that time. So there's Pavlov and Wachter paper, this paper Alex and I have, another paper Alex has. Then there's other papers showing the aggressive products relax liquidity restraints. And then we also show that the aggressive prices in the past have been mispriced and then provided essentially a subsidy to borrowers. So it's sort of the opposite of the idea that these were predatory to the borrowers in terms of pricing. They may have been predatory in some other fashion, but it wasn't predatory pricing. And then the amount of pricing, mispricing can be quantified ex ante in methods that Alex and I have done. So when we do analysis, we really like to focus on graphical analysis and looking at the data in its raw form before we get into the statistical modeling. And so we have a few pictures to start out that I'm going to hand it off to Alex. So this shows the volume of loan products in the private label market. This is data from Intex, looking at loans that were purchase loans. And so the area we really want to focus on is the green area, which is subprime ARMs with resets of less than 41 months. And so we can see is that during the time period prior to 2003, this was a tiny market. And from 2004 to 2006, this grew to be a gigantic market. And then disappeared as these products could no longer be sold into the market. What also stands out from this is that while there was a sort of general increase in purchase activity during this time period, a large part of this was new activity. So these are really sort of new borrowers coming into the market or new lending through this product. The second important thing is to look at the pricing of these loans as they was going on. So this chart shows the coupon rate on these loans over time. And we've split it out between the prime ARMs and the subprime ARMs. I've also included in the green line is the Freddie ARMs. These prime ARM product wasn't available all the way through the time period. And this shows really that prime ARMs and Freddie ARMs are really priced very close to each other. Subprime ARMs originally started about 300, 400 basis points higher than prime ARMs. And then as you look over time, you can see that the spread between those two declines. Alex and I have done additional analysis where we not only take into account the raw coupon, but we also do sort of essentially a total cost analysis where we take into account the credit risk, which is increasing on the subprime over this time, and the loan to value ratios, which is essentially further decreasing the cost of to a borrower because he has less equity to provide, so at a lower cost than the debt financing. But on this analysis, we're just focusing on the raw coupon rates. And then finally, we sort of switch this into on a national level, just sort of putting those two pieces of data together. which is looking at the spread between the subprime arm and the agency arm, and then comparing that to the subprime arm of the share of the purchase activity in the private label market. And you can see sort of very clear relationship is that as the coupon spread fell below about 2.75, the share of these arms jumped up significantly. And then, at the end in 2007, it declined rapidly. We don't think that was necessarily due to the difference in the spread during that time period. It was really just due to the fact that that market was vanishing as the originators were vanishing rapidly during that time period. So we're going to take this analysis and then extend it to individual states. But what I want to point out is, we're going to do some regression analysis here. And it's pretty clear that the regression line won't really fit exactly through these points. Really what we have is a jump in behavior from one level to another level. And we see that in virtually every time we do consumer analysis. So anytime we have proportional hazards, regression, linear regression, you should just know that really that's just an approximation of a behavioral pattern, which is not going to look like that. You're always going to see a low level of behavior. You're going to reach some critical level. It's going to increase over some period, and then you're going to reach a maximum level. And that, I say, is almost a universal behavior for everything related to consumer finance. So let me turn it over to Alex and extend this into the state level data analysis.
Thank you. The data set that we use for both this analysis and another analysis that Andy mentioned on the total cost comes from Intex, and it's probably a quite unique database of non-agency loans, only securitized loans, not all non-agencies, not the loans that banks keep on their balance sheet. But the total count of loans is close to 24 million. And we aggregated them in quarterly records. It goes by quarter, it goes by type of a loan, by shelf of origination, by geography, by purpose of a loan, and maybe some couple of characteristics, but enough to create 273,000 of quarterly records. So that's more than enough to draw statistical conclusions. About a third of those loans are loans used to purchase homes. They are important, even more important than others, because if we try to build a bridge between origination and home prices, the action and the conditions under which purchase loans are originated are the most important. The CLTV points to the down payment that borrower makes. All these characteristics are included, most importantly, rate and loan type and size and shelf of origination, LTV and FICO and some other. The home price data that we will use for this study are from FHFA, and the gross domestic product by state is compiled by Moody's. We'll start with autoregressive model for home price appreciation. So those delta are home price appreciations, basically. There was some discussion yesterday on one discussant expressed concern with this form of modeling, and even saying then it's generally okay, but not for states with bubble and declines. We try to explain what happens in those states. We add aggressive share as explanatory variable, and we reach pretty high statistical confidence and in these regressions. So we define aggressive lending here as a combination of three origination channels, three origination products: Alt-A arms, Alt-A option arms, and subprime arms. What is interesting, because it's autoregressive model, if you try to solve it, it's basically a differential equation if it was in a continuous time. The output will be a function of your entire path of aggressive share origination. So what happens in 2003, and in this chart you can actually get a sense then it was 2003 when the share of aggressive lending started to increase first. Those labels were showing the time. And later, maybe in a year or two, there was a home prices propelling up. It doesn't happen on the same day. If today's lending conditions change tomorrow, home price is not going to move. It's not going to move in a week. But it's gradually accumulating those effects, and through market forces, set up new equilibrium. So states then experience an increase in aggressive products, also saw above average home price appreciation than was clear with the statistical analysis. So another model, also based on a state-by-state analysis, is the relationship between a cumulative accumulation of aggressive share in the pre-crisis period and decline. And also, to provide some baseline, we have a GDP component here, which in some other studies we use income inflation, just to have a benchmark to compare with. We found that this relationship was highly statistically significant with R squared above 50%. We may have a different views of importance of R squared, but with only one factor in mind, it's very hard to actually find R squared of 50% in economic research of that. And in order to assess the magnitude, then each percent of excessive aggressive share led to about 0.5% of additional decline in home price during that decline period. This is another interesting model. We try to relate underpriced risk to the market share. So you remember in this chart on the horizontal axis, there was a difference between subprime coupon and comparable term agency coupon for ARMs. And that is the delta relative coupon that we have here on the right-hand side. On the left-hand side, we have market share. P here refers to the product. There are 3 of them, and I refers to the state. So what is interesting, so we try to measure everything by average beta across all these 3 products, building regression once at a time. And we found in the states that actually had high beta, and they all negative, all 50 states plus DC had negative beta, and that's interesting. Some of them had stronger, some of them weaker. They all had very substantial decline in home prices, and those who didn't take the bait didn't have much of a decline. This is the same thing shown in the graphical form, all these states, the mean of 3 slopes on the horizontal axis, and the decline, cumulative decline on the vertical axis, and 95% statistical confidence shown right here. If you look at the horizontal axis, everything is to the left of 0, negative numbers as I promised.
So the last slide really calls into question, why did this effect happen in some states and not in others, right? So in every state, we found that when there was this pricing differential that favored this product, that there was an increase, but in some states, the increase was very large. In other states, the increase wasn't very large. And in states where the increase wasn't very large, they didn't have the boom and bust situation. So, so we didn't really evaluate all of these different options, so this is really sort of more in the line of future research, but certainly if we go through other papers that have been written or some of the discussions, these are the reasons that are generally given. One is that there could be some housing supply elasticity and demand dynamics. So if you had relatively elastic supply, then maybe home prices weren't running up, so people didn't feel the need to move towards these products. There's some home ownership turnover and ARM self-selectivity, which may affect different states and whether they move to fixed rate or adjustable rate. But I actually think sort of more in these last few is really where we see the difference. So there's a risk aversion culture of product availability. California has long been an area of mortgage innovation. The original VRM mortgages were there, cost of funds indexed mortgages. So people there are just much more used to the idea of taking out products with different characteristics. Texas, for example, is an example of where regulatory laws certainly prohibit a lot of these activities. And so therefore, Texas, which might have fit very well into the sand state category otherwise, avoided this. And then what kind of banks were in these states at the beginning of the time period and what their practices were may also have a large effect. These are all testable hypotheses that we have not tested yet. So in conclusion, that it's basically what we said before. If food is cheap, people eat too much, and at least in some places they don't eat too much. Some people they eat more, and the places where the people did eat too much of the cheap food, not only they got sick, but their whole state got sick. That's it.
Okay, thank you. discussant for this paper is Javed Ahmed from Board of Governors.
Okay. So thanks for the opportunity to discuss this this paper. Thanks everybody for being here. So I thought this was pretty interesting. The authors are relating this quote-unquote aggressive lending with kind of overall real estate prices. And ideally the objective is going to be to try to explain how the use of such products amplifies price movements. So in terms of what they find, that basically in the pre-crisis period, there's aggressive product share leads to higher prices. Post-crisis, it leads to lower prices, so there's some kind of amplification kind of going on. And then they have this other result about the correlation between the the credit spread and the product share in a couple of different categories, leading to sharper declines during the crisis. So let me make my main comments on there. The first is, change in house prices, that's a pretty aggregate statistic. And in fact, they look at all changes, not just purchase loans. And I think it's being related to purchase share of aggressive products. And so this is this kind of regression where you put the change in price on the left and you put some variable X on the right and you say, okay, there's some relationship. And I guess my first thought when I looked at that was, are you allowed to run that regression? I'm not going to push on that too much, but I think the authors are pretty clear. They're not kind of over-interpreting it. They're recognizing this is an approximation, and there's no sense that aggressive share is not, there's no sense that it's exogenous with respect to what we're kind of thinking about. In fact, the price changes in real estate, might very likely determine what kind of products people want to use. So there's also this issue that, this is a major price series, home price index, and so other things are probably going on. Okay, the main story that I've seen out there is that there's this increasing credit expansion, and it'd be nice if the authors could kind of differentiate that from this quote-unquote aggressive product story. Also, is the data set representative? I'll talk a little bit more about that. And then in terms of the results on pricing sensitivity and price decline, so I think I'm going to push back a little bit on those. I don't think that result is actually significant, and the reason is that there's an estimation in the first stage. The regression that's run is actually marginally significant. I think if you adjust standard errors for the first stage estimation, that may well go away. And then the question, is this a crisis story or more general story? One of the features of the crisis is, there were big movements and you can often find correlated variables. More on that as well. I have some additional comments I'll come back to if time permits. Now, in terms of representativeness, the red line here, so this is new purchases and refinances from HMDA, and I just kind of calculate this quickly, but the red line is private label, which is kind of the focus of this study. The black line is portfolio, and the blue is total. This is dollar weighted, so number weighted, these are not quite the same. But you can see that, we're looking at action in this little hump here and this little hump here, and we're asking it to explain changes in total real estate prices. Maybe that's a bit much. To be fair, the non-agency securitized is a bigger portion when you count by number. But still, should that really be a big driver of overall real estate prices? I guess it's possible. Now, one thing I was able to do is do an alternative specification of the analysis. Having mentioned that, I don't know if you can run that regression, I did go ahead and do it. And I compared my results with what I found in the paper, and I found actually pretty similar results on a number of dimensions, except that, and I used LPS data for the aggressive share, and thanks to Paul for some of the methodology. And I find a coefficient a little bit lower, but still I find the same significance pattern. One thing that's interesting is there's 1,400 possible observations here, and the authors have only 884, so there's something missing. Now, what I did then is I looked at the different periods, and so what the authors did in terms of the post-crisis period, is they lump everything together, they look at the pre-crisis aggregate share, and they do one analysis. But there is actually a result in the panel as well, so that's, I think, interesting to look at, and it kind of goes in the same direction. And this is contemporaneous changes in aggressive share, so it need not be a story about the lead up in the crisis, but there's still stuff going on post-crisis that's still feeding this amplification. Now, this is an exercise I mentioned where you put price on the left and you put variable X on the right, and you say, okay, there's some relationship. And my first thought was, well, you know, it's a crisis, things are moving around, we could pick other variables. And so I picked a few that I thought might relate somewhat. And this is kind of quick and dirty, but basically I picked the share of loans that are held on the bank portfolio, the length of the application, denial rate, and this is all using HMDA data, and then the share that's like kind of primary owner occupied. And, you know, I found in many cases some pretty significant results, you know, particularly the length of time that an application takes to get approved, which is, I think, related to credit conditions, you know, very similar significance pattern. You know, some of the others, you know, maybe not significant, but, you know, there are kind of results in each of these areas. And so these other variables, you know, I think what it suggests is that basically we should look for more kind of aggregate credit expansion type of variables and try to bring them into play here. So I've then kind of, I've laid out each of these one by one. So this is portfolio share, application length, which, you know, the patterns look very similar to what we see with the aggressive lending variable. Denial rate doesn't come up with much, and then the primary owner occupied, you know, actually, you know, also has some pretty interesting results, although it doesn't change sign after the crisis. But one nice thing is that when you throw these variables in and you keep aggressive share, which is the variable the authors are focused on, the coefficient on aggressive share doesn't change very much, and so that's a nice like robustness exercise for the regression that was actually done. So to conclude, I would say it's quite interesting to look at aggressive share. What does it mean for aggressive share? So basically we're looking at subprime products and whether they're adjustable rate. And, you know, what's kind of aggressive about that, or is it just credit expansion? And this is a, you know, kind of another flavor of what's going on in a general credit expansion story. I would really suggest pushing more on that kind of differentiation, that if you could say credit expansion is going on, and then above and beyond credit expansion, this feature of the financial contracts being offered is actually having an impact, that would be nice. And then I'd like to see a lot more on the data set and it's being representative. So summary stats, description of variables. It was also, I just mentioned in passing that it was difficult to see exactly how some of these variables are constructed, in particular for aggressive share. I didn't know if it was share in number or dollar, didn't really know what the denominator was. In terms of the house price changes, we're also using total house price changes, but there's a new purchase house price changes series available from, I think, the same source that that could have been used as well. So a discussion of some of these modeling choices would also be helpful.
Okay, thanks, Javed. I guess we started a few minutes late, so we can take a couple of questions. Joe.
So using the food analogy, I guess the way I would put it is it the food that's making the person who eats it sick, or do people who have poor health choose to eat cheap food? In some data that we looked at with our credit panel, what we saw during the boom period was a very significant change in the composition of buyers to people we called speculative investors, as identified by having 3+ first lien mortgages on their credit file at the time of that purchase mortgage. Based on probably a very short expected holding period they favored the non-prime mortgage products because they wanted to put in the least amount of money up front, weren't really rate sensitive given their holding period. And we also showed that they were more aggressive in their bidding, and that the spread between the sale price and the listing price, controlling for other things, was higher if the buyer was one of these speculative investors. So there may be an element where it was the person eating the food. The question then is, if you deny them the cheap food, do they not show up? That we can't answer.
Yeah, so I think that would be our view as well, is that it's very hard to say what started this process. You know, was the home prices going up for some other general economic reason? or was it the availability of these mispriced products that caused the home price to go up? But I guess our view is either way, the continued availability of these mispriced products and the general, also other, concomitant decline in credit and increase in LTVs and across all the products kept this going. And so if you had cut off the cheap food, you would have limited the boom. And that seems to fit with when you look at the different states which didn't allow these products or didn't have the products, that they didn't have the same boom. So I said we can't really prove that, but anyway, that would be our thought process.
James.
I'm wondering if you looked at the effect on different pricing tiers within any given geography. There's usually higher priced and lower priced housing. And I think Case-Shiller has tiered HPI series. And I think they find that home price appreciation and then decline was greater in the lower tier, which might make sense if, there was more credit being extended to subprime type borrowers. Also, the loan level data sets have the sell price of the home. So you could, link that price of the home to the type of mortgage that it was financed with, if you wanted to drill down in that way.
Yeah, I think all those are good. Like I said, we found similar issues on every type of loan, including agency loans at every price level. This is just the one that stood out the most in terms of the biggest mispricing of the loans and the biggest increase in volume relative to what it had been before. But I do think that that kind of research would be useful as well.
Subprime was, subprime may have been lower income, lower price homes, but a lot of the Alt-A, there was a lot of jumbo Alt-A or higher priced homes, homes financed by Alt-A.
So Andy mentioned this in beginning of presentation, and a lot of our conclusions are actually based on the total cost analysis, which is not just, and when we say underpriced loans, you might ask a question, why are they underpriced? Like there is a subprime loan, how can we say it's underpriced or not? So one component is the coupon, is the payment that they make, but then there are two others. There were high LTV loans, that means people making low down payment. So if you blend one with another, you get certain message of reduction, and there is an underpriced credit risk, which we estimated using this credit OS methodology. It basically ex ante attempt to forecast annualized losses, and losses is what borrower doesn't pay, and further reduces. Has a very high correlation with home prices, and anti-correlation, of course, with home prices.
I think we need to move on to the next paper.
That was final. Thank you very much for the comments. They're extremely useful.
This is Doug Evanoff will be presenting. Doug's from the Federal Reserve Bank of Chicago.
No, that's okay. We were taking up too many seats.
And he has several co-authors, Jean M. Roman, Itzhak Ben David, and the paper's called Loan Product Steering in Mortgage Markets.
What's that? Yeah. Not the up and down keys? Yeah, okay, it is.
Okay, you can use this, and this is the
Okay.
pointer.
Oh, it does, okay, the pointer works, okay. Very good. Thank the organizers for having us on the program. This is joint work, as he said, with Gene, Sumit, and Zai. Each of has been affiliated with the Chicago Fed in some capacity in recent years. And again, the standard disclaimer. Issues during the housing run-up. There's been a number of accusations of questionable lending practices, some predatory actions, unjustifiably high fees and rates that were imposed on people, prepayment penalties, and an effort by originators to push for unaffordable mortgage offerings. But there's little hard evidence, hard research in this area. At least we found little hard research in the area. A lot of anecdotal information. We've got to select regulatory enforcement actions. We do have select regulatory enforcement actions and some isolated lawsuit. But we'll argue there's no methodical evaluation that shows some systematic evidence of such behavior. So what are we trying to do? Address that, obviously, identify and evaluate the effects of practices that are consistent with predatory lending practices. The form of predatory lending that we're considering is credit steering, and I'll talk a little bit more about that and define exactly what I mean. I think people in this audience knows generally what that is. Our approach, we need to find evidence of steering, okay, and then evaluate the impact of that on the borrower. What's the impact on the credit terms, the loan characteristics, the performance of those loans that we say have been steered. Preview of our findings, we find evidence consistent with credit steering, find evidence consistent with higher APRs being imposed on these loans that were steered. The steered borrowers received inferior loan characteristics. I think what most people will argue, there were unfavorable loan characteristics, and that the steered loans actually were of higher quality, better performing loans vis-a default rates in the future. So it will show sometimes that was quite significant. We also found that steered loans are more likely to be securitized, generally private label issues. We also find this is not exclusively a large bank issue, which quite frankly, I thought it would be when we first started. And we find it extends beyond that. So that's the preview of the findings. Background, when I think of steering, I've always thought of geographic steering, quite frankly. An effort to perpetuate segregation in certain neighborhoods, not showing people certain neighborhoods when they're trying to buy a home. Credit steering, I think, a more recent phenomena. The idea is the unsophisticated borrower is misled, and he ends up getting a product that he's overqualified for. Why? Well, it could be the lender compensation could be tied to that excess. We tried to address that, both with regulatory mandate and Dodd-Frank, and not allowed to do that now, but we know that it did occur during the early 2000s. But there's little hard research on this. What has been done is if you look at a group of people that you think may fall into these camps and be subject to being mistreated. And some of the studies that I've listed is Sino, Embergluck, and Smith, and Freddie Mac. They argued that about 10 to 35% of the subprime borrowers should probably be prime borrowers. And Michael Barr argued that many of those were steered to high, that's a result of many being steered to higher cost lenders. And that's what we're going to look at. I think we've come up with a means of seeing the average steered to higher cost lenders. So it's a three-step strategy here, and I have to do all three. I have to satisfy you on all three of these. The first one is to identify the loan applicants that we argue there's evidence consistent with them being steered. Second one is develop a control group to compare those against, a peer group, if you will. And then third, to empirically determine if there's performance differences between the two groups. Well, performance, we'll argue, is the pricing of those mortgages, the characteristics of those mortgages, and how they perform. Okay, so step one, this started with discussions with Federal Reserve Bank of Chicago's Consumer Affairs Group and arguments back and forth, give and take, push, them arguing, we know this type of behavior is going on, and I'm saying, show it to me, and they're pushing back and saying, I can give you specific examples, again, the anecdotal type of information, but how can we capture that, how can we quantify that, and came up with one means of possibly addressing that, and if you envision a borrower walking in, trying to get a loan into Bank A, and I'll do this Bank A and Bank B throughout the analysis here, into Bank A, Bank A says you're not qualified for a loan, but we have an affiliate which you may be qualified for, and passes them on to entity B, I don't want to say bank here, entity B, and then they get a loan from entity B. Okay, and that's the concept conceptually that we're looking at here. Why might this be done? Well, if it is going to be trying to take advantage of it, a lot of people argue that banks did not want to get into this type of activity early on. There was reputational effects that were getting a lot of the subprime activity, questionable activities. At the same time, it's a very lucrative business, And Litan's got 2 or 3 articles in the late 90s talking about how banks were torn, whether there's reputational effects. We have deep pockets. We want to, if we do get into this, we want to keep it separate. And at the same time, they were acquiring entities that were indeed involved in this type of lending activity. So it could be efficiency arguments for doing this activity in a separate entity, and it could be reputational effects you're trying to protect. Our criteria for the steered loans then is you walk in to get a loan. As you all know, the HMDA data doesn't have Paul Calem's name when he walks into Bank A, and we see that he got denied there, and then look at Bank B and he had a loan accepted. We don't have that identifier, so we have to come up with a way of tying those two together. So our criteria for steered loans is if the HMDA applicant has been denied a loan at one bank, and we find a loan pair that's been approved within a month, actually 31 days, that matches on census tract, race, gender, loan type, purpose, occupation type, and amount of the loan and the dollar in the income. And the last two, we don't require them to be exact, but they're very close. We do regard they're very close on those as well. And then the second point, very important, where if you get those paired, Bank A and Bank B, the lender or Bank B here is affiliated with the original institution that denied the application. So what we're looking at, and we're saying affiliation, we're doing it through the holding company structure. So we're going from Bank A denying the loan, Bank B approving the loan, and both of them, they're affiliated through the holding company structure. Now, this constitutes our steered borrowers. We know there's the possibility of a lot of steering activity that's going on that we're not capturing. That's not our objective, to catch all steering that takes place. We're trying to come up with a methodical means of capturing in a systematic way some questionable activities. Steering could be good or bad. You could be steering these guys to Bank B because they really don't qualify. You can't put them into a prime loan. So what we need to do is, what are the characteristics of those guys, and what's the characteristics of the loan they end up getting? So we try to come up with a control example or peer group, as I described earlier. And we do the exact same thing in the markets, exact same control variables. And the only difference is we don't have them affiliated to the same holding company. So there's a difference there. So there's the inability, if you will, to steer within the same organization. Now, steering is considered bad when compared to this control group. They don't have as favorable characteristics, or they have worse, a better way of saying it, characteristics. Okay, and what I have here is the smooth kernel density relationships with 4 variables between the control group and the steered group, and with respect to income, the dollar amount of the loan, the FICO score, or the DLTV. And we'll argue they're essentially indistinguishable. Very, very close control groups that we're setting up. The data, this audience knows this data. It's the HMDA structured data files, McDash apply, CoreLogic, and I know there's been mergers in this data. The call report data and the HUD predatory lending list. Relatively strict criteria. If we're making an error, we will make it on the side of not capturing some of these steered loans as opposed to vice versa. I'm going to come up with 26,000 plus observations, steered and matched over this 2006 time period. We're interested in the run-up to the collapse in the market. So our empirical approach, our basic specifications, we're looking at a response function, and what we're looking at is the APR on the originations, the loan characteristics, various loan characteristics, and the loan performance. Those are response variables, and we're going to see what the impact of being steered is on that, as well as a number of fixed effects, and I'll try to lay those out. And a broad array of loan characteristics and borrower controls, borrower characteristics, okay? And I won't go through all of those, so I'm not gonna show them the results that we have here. I encourage you to look through the paper. And frequently we go through and start out with a number of controls and simply add to that to try to the kitchen sink, throw the kitchen sink to this to try to get the result to go away. Okay? So this is, look at this, the top half of this, we're looking at what the APR is on these loans. And the thing we're trying to capture the impact of is whether or not they were steered. And the top half of this, we've got 4 different specifications. Okay, in the top, going across the top of this, we're controlling for both the location and the time fixed effect. And we're looking at what the impact is. We're simply adding control variables as we go from left to right. And the impact of steering on an average rate APR of 6.54%, we've got a surcharge, if you will, anywhere from 48 basis points to 60 basis points. And the only difference from this and going to the bottom half of this table is we're accounting for bank fixed effects in addition to the other fixed effects. We get less of an impact, still statistically significant and economically significant, we'll argue, impact resulting from being included in the steered group. The impact is less, we're controlling for bank effects, fixed effects here. Bank has such a strategy. Okay, it's not surprising then that some of it's being absorbed into that fixed effect. Then we look at characteristics, and in this, we're looking at top half again, only has the 2 fixed effects. The bottom half, we capture the bank fixed effect as well. We're going through and seeing whether or not it's an ARM, whether or not it has a balloon payment, whether or not it has a prepayment penalty, etc. And whether you look at the top or the bottom of this, generally, that doesn't hold true in all cases, but generally, what we consider less desirable characteristics of the loan, there's a higher probability of those being received by the steered loans. And I should say, it was on the slide and I didn't say as we went through, these are OLS estimates. We've got the probits. These are easier for me to look at, interpret, and talk about in terms. I can give you the probit analysis on this as well. So higher probability of less favorable characteristics. What I think is the most important here is looking at the quality of these loans, the performance of these loans. And we look at 90-day delinquency. And again, we're going back to left to right, simply adding control variables as we go through. On the top, just the 2 fixed effects. On the bottom, the 3 fixed effects, and counting for the bank fixed effects as well. And what we end up with essentially is lower probability of default from these steered loans, or for the steered loans, in almost every specification that we have here. Well, taking a step further, how are these things allocated? What happens to these steered loans when they're generated? And I'm running out of time, so I'll do it relatively quickly here. The coefficients themselves don't matter as much as the relationship between them. Do they go to portfolio? Do they go into private label? Or do they go to GSEs? And what we find is a strong potential for them to go into private label and a strong desire, for lack of a better way of putting that, not to hold them in portfolio. And we argue, in essence, what we're generating here is an attempt to satisfy demand for securitization in the analysis. There's a significant demand for high-quality mortgages. This is one way of satisfying that. Let's go to here. Let me talk about some extensions that we're considering with this. And the wording here is terrible. This is not in the paper, so I'm going to discuss and can't question just things we've done recently on this. We have what we consider very stringent criteria to be included in the steered group and even defined a match for the steered group. We weaken that selection criteria to a certain extent, and we looked at propensity scoring to see if we can match not on exactly every variable, but some scoring mechanism across the various variables we're trying to match on, okay? So we're relaxing some of the restrictions that we have. We end up, in this example, with about six-fold increase. We've been asked to try to come up with larger numbers. We come up with about a six-fold increase in our number of steered loans. And the results hold true. All the things we've talked about earlier, essentially very similar, slightly smaller coefficients, slightly smaller effects, but essentially hold true. We also go through, and I like this, we compared the steered loans to the loans of Bank A and loans of Bank B. Okay, and very quickly, higher quality loans than Bank B's other loans. Okay, and essentially the same quality of loan from a performance standpoint than what Bank A was generating. Okay. Bank A was the one that denied the loan. And we've been asked to look at the determinants of being steered, which is a tough nut to crack, quite frankly. And you think about a borrower coming in, the person looking across the table at them, trying to decide whether or not they can lead them in a particular direction or not. You can think about racial, ethnicity characteristics, you think about gender, perhaps a marginal FICO score. Are they right at the cusp? Does that make a difference in enabling me to do this? Perhaps low doc type loans. We haven't done a lot of this, but we have intentions of doing this. So I'm out of time. I don't need to tell you again what I've already told you. I'll just leave you on a little needless note here.
Okay, thanks, Doug. Our discussant is Leonard Nakamura from the Research Department in this Federal Reserve Bank of Philadelphia.
Back and forth, this is the point.
Okay, thanks a lot for the opportunity to discuss this terrific paper. These are the usual disclaimer. So this is a really smart research design that gets at a difficult and important question. So were borrowers channeled into bad products that worsened the housing bubble? How quantitatively important and how bad was the steering, and what happened to these loans? And there's pretty powerful anecdotal evidence that I'll give later from the Financial Crisis Inquiry Commission about WAMU, that the steering occurred in really quite substantial quantities. And I just have a few suggestions to make this great paper even better. I mean, the writers of this paper are kind of an all-star cast. These guys really know how to write a paper. I recommend that you read it. It's very easy to read. They show evidence of steering, cases where a loan is denied by a lender and very quickly another loan is accepted by a subsidiary of the same institution. And these loans pay higher interest rates and default at a lower rate than other similar loans. And they, as a comparison group, they have borrowers who had loans denied by a lender and then another loan accepted by a lender unconnected to the first lender. And the conclusion is that the steered borrowers were worse off. And they ask whether these loans were held in portfolio or securitized. And it turns out they were securitized and served to sweeten those securitizations. Okay, so if you read the Financial Crisis Inquiry Commission report, they tell you that in 2002, WAMU, then the nation's second largest mortgage originator, the biggest S&L, realized that they were losing money on their plain vanilla mortgages and decided to steer customers to option arms, a much more profitable product. And you can read the memo that's written by the head of the mortgage group where they describe this in pretty, as if it's a calamity that's about to happen to WAMU. And so they then go on and you get other memos that show that customers aren't asking for this product, and the mortgage brokers at WAMU, a lot of them thought it wasn't a desirable product. So they had a tough management job to get the customers to take these option arms. So, but WAMU did, what you do if you're a marketer, you do focus groups and all kinds of stuff, and they put incentives in place to get brokers to steer their customers. And you see they go from 30 billion option arms sales in 2003 to nearly $70 billion in 2004. At that point, they're more than half of WAMU's mortgage originations. And these, Jan Bruckner, Paul, and I have a paper on option arms that show that these option arms and IO arms ultimately defaulted at a substantially higher rate than other mortgage schemes. So anyway, so this is a really important issue, and they've gotten a very clever way of getting at it very carefully. So they start with 3 million rejected accepted loan pairs. Am I getting that correct?
That's right.
And they wind up with 13,000 steered and unsteered loans, 1%. So, why are there so few steered and unsteered loans? And he said that they can bump this up to something like 6%. Does this definition of steering include WAMU? My guess is that it doesn't, but it would be good to be very clear about that. And it'd be good to get, if they can give us any sense of how prevalent steering is in the overall database. And how concentrated is this detected steering? Or, a third of these loans coming from a couple of banks. And 50 basis points higher interest rates, maybe 140 basis points. These are the, I may be exaggerating this a bit, but in net cost to borrowers looks pretty big for these. So one interesting question is that these banks' loans are not being held in portfolio, but they're used to sweeten the pot of securitization. Right? So these are better than the average loans that are put into securitization. So a big question is, how did these loans affect the pricing of individual securities? How did the sweetening work? Are the buyers of the securities aware of these cherry-picked loans? If so, you should see that directly in the pricing of the securities that included them. And that'd be very valuable, because there's been all this talk about how little the buyers of the securitizations knew about the contents of these loans. If you can reach into this level of detail, that's pretty convincing evidence that these guys knew what they were doing. Or was it just like a reputational good? That is, did this sweetening just help out over time? There are minor empirical issues they don't control for retail versus broker loans. Do their IOs include option arms? One thing that would be good is to get some more dating in here. What was the role of steering in the housing bubble? Do we see more steering beginning in 2003? When does steering taper off? And how concentrated was the steering? And teaser rates. They should do something about the teaser rates in other empirical work. It appears that teasers result in a bimodal distribution of interest rates, so you can separate them out. I'm almost out of time here, but a key issue here is this just a caveat emptor issue? That is, you know, you go into a medical office and and the price that you get charged depends on whether you're insured or not, right? And I mean, it's just there are all these crazy things that happen in the pricing of competitive markets, and you know, is this just that you can be taken advantage of if you're not so swift, or is there a social external harm here, right? What's the ground for regulation, right? And so an interesting question is, what was the external harm in this steering? The borrowers steered to products that defaulted more and that worsened the housing boom. Can we tease out this quantitative external impact? Did steering good borrowers to these products make them more acceptable to the market? And in some sense, did having more good borrowers in the short run help securitization sales later? And did that worsen the housing boom? Anyway, this is really terrific work. I highly recommend it. You read it.
Okay, thanks, Leonard. I guess we have time for maybe a question or two.
Charles Capone with JP Morgan Chase. I have a question. I'm just concerned about your fundamental definition of steering, because a loan denial is very late in the process, and it means that I, the loan officer, have sent it to the underwriter, and I'm only going to send it to the underwriter if I think there's a good chance of approval. So the underwriter's found something that I could not get fixed with the borrower, and I'm going to lose the commission then if I pass it off to the subsidiary, and that guy's going to get the commission. So there's a tension here in choosing this point. Steering has to occur much earlier. So I'm wondering if possibly some of what you're picking up here are people that, you know, the officer thought they could get them through the underwriter, but there's something they couldn't get through the underwriters. And so this borrower is desperate. They want to buy a house. They've got a contract. If they get another loan within 30 days, starting over again, that's tremendous. And so they're desperate because they're desperate to close on this house deal. You know, they're going to take the higher cost mortgage because they feel like they're in a bind.
Okay. One of the things I did early on in this was really push hard with our community affairs group, and I need to talk to you more about the timing involved with this. And my initial response was, why even fill out a HMDA? I mean, why even do it? And they said, oh, no. If they do it right, they will fill out the HMDA file. Now, if they don't fill that out, we're not capturing it. I agree with that entirely. But what you're describing as the timing is a little different than what I was envisioning originally.
There could also be withdraw the application too, rather than denial. That's an earlier step.
What was I didn't hear you.
Withdrawal of the application is also an earlier step than denial.
Sure. Okay.
And this is Rajesh from JP Morgan. I just want to add, you know, what about the mortgage brokers, right? I mean, during the boom period, there were these players, the mortgage brokers. A lot of the loans actually went to brokers rather than, you know, customers walking into a bank. And then the brokers, of course, they see all of these different prices, and then, you know, they have incentives, I guess, as well.
The question with brokers, I probably am not capturing those because my understanding is it's not the broker that fills out the HMDA report. They provide that information onto the lender who fills it out. So you're probably getting a scenario where you don't have the broker saying we talked to him about one but ended up giving him another. Yeah, so that's right. We end up with losing a lot of observations in this process, and that's probably a reason for it. Some of the lenders not going through and filling it out, some of it being generated by brokers, and that's the other side.
Okay.
But we're not arguing we're capturing all of them. We're trying to come up with a systematic way of capturing this. Also, I agree with Leonard entirely that we need to do a better job building out the waterfall. Where are we losing our observations as we go through? As we merge these data sets together. And what's our final sample? Was it concentrated in 2004, 2005? I don't know off the top of the head, but my guess that's when activity was outrageous. So it probably isn't smooth across all the sample period.
Did you check how closely the steered and the control group match on reason for denial, reason for the first denial?
We did not. Appreciate that. We did not, and we can't. It's a good suggestion. Also, the idea of following this through the securitization process, I think is a great idea. I think it's a lot of work. I'm not sure. I need to talk to some people as far as the data and what we can get access to. I almost see it needing to go to Bloomberg or something like that, but okay.
Do we have time for a question?
I think it's a great idea. I appreciate that input a lot.
One more question? Okay, we have time for one more question, I was told.
I'm worried about your control group. So what if these lenders like Bank A, they just see something about this borrowers and, you know, if they're slightly better, they steer them to the affiliates. If they're slightly worse, they just say no and that's it, go away. And then they go to Bank B. So like your control group or your feedback group is very nice, but your control may be kind of have this, you know, selection.
We may need to talk about this. I'm not entirely sure. I agree with what you're saying. They're going through Bank A, who's making an explicit decision. I don't see the steering, but we can talk about it.
Thanks, Doug. Move on to our last paper by Wayne Passmore and Diana Hancock from the Federal Reserve Board. It's called Cost of Funds Index Mortgage Contracts with Government-Backed Catastrophic Insurance, a realistic alternative to the 30-year fixed rate mortgage, maybe. And this is more about looking forward than looking backwards. So it's good,
That's right,
good switch.
Paul. We're looking forward, but we're going to look backward to look forward. I'd like to thank the organizers for putting this paper on the program, Julapa, Paul, Ken, Bill, and also I want to point out that the results that we're going to talk about today are used to stimulate discussion and critical comment. The analysis and conclusions set forth are those of the authors and do not indicate concurrence by other members of the Federal Reserve staff. So this paper is in line with Doug McManus's paper. Is there something different than the 30-year fixed rate mortgage? The 30-year fixed rate mortgage has become a popular feature of U.S. mortgage markets because households perceive that such mortgages are affordable because they're amortized over a long period. They're stable because the payments are predictable and do not vary much over the life of the loan. And they're flexible because they can generally be prepaid by the borrower at any time without penalty. But we learned during the process, households may need to sell before they've built up enough equity to pay transactions costs, particularly if house prices are not rising. In volatile economic or interest rate environments, it's difficult to maintain a private market for these loans. And in a substantial downturn, GSEs can impose substantial costs on taxpayers, about $180 billion. Recently, there's been a lot of interest in looking at alternative mortgage contracts. Wayne and I have looked at an option to pay off your mortgage with proceeds from a home sale when the homeowner moves. This we call the buy your own mortgage contract. There's also the variable maturity mortgage that would hold a household's monthly payment constant by adjusting the maturity of the mortgage in response to changing interest rates. These are sometimes called VMMs. Campbell has argued that a fixed rate mortgage with no prepayment penalties might be a better contract. And Olener and Pinto have recently put forth a wealth building home loan, which is a 15-year fully amortizing fixed rate loan that repurposes a 5% down payment for a 1.25% permanent rate buy down. So this paper is in this new literature, and it proposes a new mortgage contract that is based on an index of depository institution cost of funds, that's a coffee, that would be eligible for government-backed insurance that would cover only catastrophic losses. So we're going to call these contracts coffee cat mortgages, and we're going to tell you what might have happened if they were used in the past. So, how can one differentiate a good contract from a bad mortgage contract? Campbell argues that we should consider 8 questions. First, does the mortgage contract fairly share interest rate risks? Second, does the mortgage contract create unnecessary prepayment risks? Third, is the mortgage contract easily funded? Fourth, does the mortgage contract bear surely the default risk? 5, does the mortgage contract provide appropriate incentives to underwrite mortgages properly? 6, does the mortgage contract mitigate the negative externalities imposed on communities from large numbers of mortgage foreclosures? 7, is the mortgage easy for borrowers to understand? 8, assuming the mortgage contract is widely used, how does it influence the incentives of macroeconomic policymakers? We're going to employ historical data to consider the strengths and weaknesses of copycat mortgages using this 8-question framework. So we start out and we look at the 30-year fixed-rate mortgage, and we're going to compare that to our proposed cost of funds index. The cost of fund index we consider is the total interest expense of domestic commercial banks divided by their total liabilities. Copies that have actually been used, there's the 11th District Cost of Funds Index that's published by the Federal Home Loan Bank of San Francisco. And there's also a copy that's based on Treasury securities. So this is neither of those copies. So that's the first difference between our work and previous work on copies. You'll notice here that the copy time series that we propose is much smoother than the 30-year fixed rate mortgage time series. And the reason is that deposit rates adjust slowly compared to market-based interest rates. So the first questions we consider is sharing the interest rate risk and not creating unnecessary prepayment risks. So a depository institution with a portfolio of 30-year fixed-rate mortgages, or GS mortgage-backed securities, on its balance sheet will typically carry an off-balance sheet portfolio of derivatives. They have to use these derivatives to hedge both interest rate and prepayment risk. These are very difficult to hedge. Their derivatives book is typically very difficult to value, and the valuation is volatile over the interest rate cycle. In contrast, the copycat mortgage would be tied to depository institution costs of funds. I'll talk a little bit later about the potential hedging costs associated with that. To estimate the rate that depositories would charge for a copycat mortgage, we're going to adjust the 30-year fixed-rate mortgage for interest rate risk, prepayment risk, and credit risk. And then we're going to take that, and because these mortgage originators are implicitly pricing these risks, we can figure out a markup over the secondary MBS yield. And then, typically the banks originate the mortgage and then sell it as quickly as possible to the GSEs. So our copy markup is going to be estimated using historical data. And one of the things we went to look for is how are MBS prices empirically described in the literature. And there's a paper by Boutikou, Whitelaw, and Richardson, Stanton, in 1997. What they basically show is that MBS prices can be described using the level and slope of the term structure. And the interest rate level is going to proxy for moneyness of the prepayment option, the level of prepayments, and the average life of the cash flows. And the slope basically controls for the average rate at which cash flows should be discounted. So we've added to this model swaption volatility. That wasn't available in 1997. And we are going to use this to measure the uncertainty that will be faced by MBS investors. MBS do not have credit risk. but the depository institution has to pay a G fee to the government-sponsored entities. So we're going to include the G fee in our model. And we're also going to control for credit risk by including the median credit score for conforming mortgages. As you know, recently with quantitative easing, the Federal Reserve actions in MBS markets have also greatly lowered mortgage rates. We're going to include some controls for the Federal Reserve actions in those markets. Don't expect you to read the equation, but the coefficients, but we estimate a mortgage rate regression. It includes all the various variables that I just described, and the dependent variable is going to be the contract rate on 30-year fixed rate mortgages, conventional home mortgage commitments available from Freddie Mac, and the coefficients in our mortgage rate model all have the expected signs when they're significant. And we also looked at the whether the mortgage was stationary, and residuals are indeed stationary. So what do we use this for? Well, we take our predicted rate on 30-year fixed rate mortgage and we compare it to the predicted rate on our copycat mortgage. And we have a markup. The markup is that blue dashed line. We have our predicted fixed rate mortgage for 30-year fixed rate mortgages, which is the black line. And we see that the cost of hedging is between 2 and 4 percentage points over the time period from 2000 to 2014. As you see, the predicted copycat rate, which is the predicted mortgage rate minus the cost of swaps, is much lower than the 30-year fixed rate mortgage for the entire time period that we have. And you also notice that it's much, much smoother. This is because the hedging costs are actually quite volatile on 30 fixed rate mortgages through the time. We then also calculate monthly payments for copycats versus 30-year fixed rate mortgages. And we also look at that over the whole time period. And we consider the median value on a home with an 80% loan to value ratio. And you can see in the early years in particular, the monthly payment costs are much lower for copycats. And over time, you can see that the mean value is about $381 a month. So that's a lot of money to put in people's pockets over time. What's the cost? Okay, you don't get money for nothing, not in the U.S. So for that reduction in cost, the homeowner is going to bear some interest rate risk. The predicted copycat mortgage responds slowly in response to rising rates. Anyone who has a deposit probably notices right now that might actually be paying money to the bank to keep their money. We didn't take that into consideration because we only look at what they pay, not what we pay. But when rates decline, the copycat mortgage rate is going to respond fairly quickly, just like deposit rates do. So the homeowners with the copycat mortgage are not going to have to bear those costs of refinancing when rates fall. They don't have to pay for the prepayment options for when rates fall. And it's because there's a natural hedge between what the bank's cost of funds is and what the mortgage that they're funding is. You have to bear some interest rate risk to get those monthly payment savings for homeowners. So that's the trade-off that we're considering here. So another piece of this is, well, how would these copycat mortgages be funded? So copycats, of course, work well with a deposit-based system. If you look over the last 20 years, regional imbalances in deposit financing systems have been reduced with the advent of both nationwide banking and also the evolution of the Federal Home Loan Bank system. Deposits tend to be sticky, and during the recent crisis, we found that depositories received large inflows of deposits, which drove rates down even quicker. So the copycat mortgages would make it easier to match fund mortgages with deposits. If you want to look at coffee versus LIBOR or coffee versus treasury rates, you can see here that market rates move higher than coffee when there are periods of volatility and lower than coffee when there are flights to quality or when there's aggressive monetary easing, like in the most recent period. By looking at the two charts at the bottom, LIBOR is on hopefully your left and the Treasury is on your right. What about sharing default risk? During GSE reform proposals that look at catastrophic mortgage, usually have three policy parameters: the homeowner's down payment, the size of the first loss position that'll be held by private sector investors, and the government G fee. Homeowners can think of this as paying two fees. One to the private sector that'll back the first loss position, think of this as PMI, and one to the government that will back the catastrophic losses. Think of that as the G fee. The government-backed catastrophic insurance could even be accomplished by having the government guarantee the copycat mortgages that are held in portfolio on the bank balance sheets, or it could securitize the copycat mortgages using the GSE securitization platform, or it could reinsure its credit guarantees using credit-linked bonds that reference the default performance of a pool of selected copycat mortgages that are held by the originator. So we tried to look at a simple way of how much to figure out how much it would cost for catastrophic insurance. We suppose that we use a three-tranche structure, a highly liquid information insensitive tranche that's guaranteed by the government. Think of this as a AAA piece. A mezzanine tranche that's held by the private sector to cover the unexpected non-catastrophic losses, and a residual tranche that concentrates credit risk, covers expected losses, and is held by the private sector. And I'm going to focus on one example where the premiums paid by the household are for 98%, where the government covers only 2% of the most extreme loss outcomes. And I'm only going to focus on the left three columns where you have a 1 in 50 chance of a crisis, as opposed to a 1 in 20 event, which is the right three columns. And if you look at the 98%, which is a 2% extreme loss every 50 years, the homeowner would pay an annual premium of about 28 basis points. That's in the square brackets in the dark green there. And in addition, the originator bank would pay 7 basis points to the government to cover the catastrophic outcomes. You'll notice a 1 in 50 event, all those columns have much smaller numbers than if you have a 1 in 20 event, which is the three right columns, which makes sense. More often you have a crisis, the bigger money you're going to have to pay for catastrophic insurance. So the copycat margin versus the G fees, you'll see that the G fees are in blue here. You see they're very high right now. That's because the Treasury is trying to encourage private sector involvement. The copycat margin is lower than the G fee at the current time, but it was higher than in historical experience when arguably G fees were too low for the risk that was undertaken by the government. Copycats are easy to understand, easy to calculate using nationwide data. They're predicted to be lower than the 30-year fixed rates. Borrowers benefit when rates fall. There's no refinancing costs. And monetary policy transmission is more effective in a low-rate environment. We would argue default rates are lower too, because you're putting cash in people's pockets immediately when interest rates fall. When rates rise, deposit rates are slow to adjust, so households have time to adjust to the higher payments. So in conclusion, we show, using historical data, that copycat mortgage would lower the cost of owning a home, provide incentives to underwrite contracts properly, reduce macroeconomic impacts associated with large declines in home prices, and enhance the effectiveness of macroeconomic policies. Had homeowners had copycats during the recent crisis, we wouldn't have needed to have HARP, HAMP, all those sorts of things. And you wouldn't need to have to requalify in order to refinance your mortgage at a lower rate. Because deposit rates and other funding costs at deposit institutions fall faster than they rise, they have an asymmetrical relationship with market rates, which leads to greater financial stability of these mortgages. And the explicitly priced catastrophic insurance for such mortgages would reduce the moral hazard associated with the implicit government backing of the GSEs. My time is up.
Okay, our discussant is José Canals-Cerdá from the Federal Reserve Bank of Philadelphia.
Thank you. Back and forth, laser point.
Great. Thank you very much. This is a very interesting paper and a very important topic. This is both policy proposals and an economic paper. And I'm going to focus on the economic aspect of it, not as much, well, not at all on the policy aspect of it. So some of my comments might not be as realistic as the title of the paper. First thing, some general comments. The proposal won't please everyone because of all the proposals out there, I don't think there is one that is Pareto optimal. They are going to have advantages and disadvantages. The second issue, and this is, I think, related to a comment by Bob Avery before, is that I think the authors need to, work a little bit harder at clarifying what kind of market failure they are trying to fix. And I'll discuss that a little bit later. There is a lot of alternative proposals out there, so I think the paper will benefit from maybe a couple of paragraphs discussing those proposals and discussing where their proposal fits into that framework. I think the authors, are renowned experts on the field, so to a certain degree, I feel like they need to be a little bit more critical of their own proposal. And, as I said before, there is no Pareto optimal proposal here, so, I think the reader will benefit from understanding some of the, potential issues with the proposal. The paper does a very good job of criticizing the GSE model, but then the model that they propose have some of the similar features. If you're proposing government participation in this market, basically you're going to have to consider potential for, dominant position of this institution. In the long run, potential deviations from stated goals, political influence, failure to innovate, mispricing of credit risk, lack of market discipline, another type of distortions. So, this is one of the drawbacks of government intervention. So the authors do a great deal of data analysis, but I feel that a little bit more of analysis would still help improve the paper. So what I have here is basically the quantile distribution of a coffee that I have defined, which is not exactly the one that they define, and I'll talk a little bit more about that. The bright red line is the coffee that is being created by the San Francisco Home Loan Bank. So as you can see, it doesn't exactly fit into my definition just because there's many ways in which you can build this, and I chose the more simple one. And by the way, I wanna emphasize that data work takes a lot of time, and I haven't spent that much time, so there might be issues with what I'm presenting to you. So hopefully, this is just to stimulate the authors to maybe do a little bit more work on this area. So one thing that I see from this quantile distribution is basically there is a lot of heterogeneity in cost of funding across banks. Okay, and the next picture basically shows you again the distribution of cost of funding across banks and over time. And you can see basically in year 2000, which is the blue line, interest rates were higher, but also distribution was very wide and the same across years. So where does this heterogeneity come from? A candidate that anybody would think of is asset size. Okay, so basically here I have 3 examples where for 3 different years, 2003, 2006, 2009, showing you basically the coffee distribution across different asset sizes. 2003, you can see that larger banks have a funding advantage because the funds lower. But then in 2006, looks like the cost of fund of larger banks kind of took a dive in a way. And then by 2009, we were kind of back to the original 2003 picture. And then, as you see in the next picture, basically 2007 and 2008 was kind of a year of transition. Okay? Now, this suggests a lot of different things. One thing that it suggests is that how you build these coffees is going to be very important. So are you going to do an average? Are you going to do a median? Are you going to do a asset weighted? How are you going to do it? Some information on that will be useful. Also, as it has been mentioned before, there are some coffees that have been generated, and if we look at the LPS, there is some coffee loans there. Most of the coffee loans actually were originated between mid-80s and mid-90s, okay? And if you look at that, there is about, in the first mortgage, there's about 500,000 of those. So it might be useful to look at those and see, how they perform. So I'm going to do a little bit of that, not too much. So if you look at the ARMs, basically these are the 3, in the LPS data, these are the 3 different indexes that are used more often. Okay? The LIBOR, the T-bill, and the coffee. And as the authors indicate, basically the coffee is a little bit of a slower one of all them. They doesn't adjust as fast as the other ones. Now, these are the indexes. How do they reflect in the real market? So that's where, looking at the LPS mortgages, that's kind of what I'm trying to answer. So this is basically the 50, 25, and 75 quantile distribution of coffee loans in LPS. And basically, I focus on loans between 75 and 2000, year 75 and 2000. And then this is the similar distribution for ARM loans. Okay? And this is basically comparison between the 50% quantile comparison of both. So you can see that sometimes the coffee median is above the ARM median and sometimes below. So recently the ARMs have been providing lower interest rates than the coffee. So the authors basically go through a list of items that a good mortgage should satisfy, and so I just want to go through that list also. So basically, in sections 1 and 2, they address the first 3 issues that they think they should verify: a fair share of interest risk, well work with deposit base, and avoid unnecessary prepayment. In terms of fair share of interest risk, we need to keep in mind that in this proposal, the interest risk is borne primarily by the borrower. Now, looking back, which is what the authors do, it is the case because we have had, for the most part, an environment of decreasing interest rates. It is true that variable interest rate would have been preferable. But is that the kind of analysis that the authors need to do, or do they need to do something a little bit more? Because basically the proposal is not backward-looking, the proposal is forward-looking. So what can we do to validate this going forward? Some other kind of analysis, maybe some bootstrap analysis, I don't know, something, Also, I have a problem with the concept of fair because I wasn't taught in graduate school about this. I was taught about Pareto optimality, so I don't know exactly what fair means. My daughter probably knows better than me. So the deposit-based aspect of it, So I'm a little bit concerned about the heterogeneity on the coffees that we have observed and how that is potentially going to impact potentially banking structure. Okay, so we have seen that some banks have relatively low cost of funding, some have relatively high cost of funding. So that heterogeneity is something that the authors need to think a little bit about. They also claim that refinancing will be unnecessary. And I think to a great degree they are right, but there's still some cases in which one can think of refinancing, for example, borrowers that improve their credit rating and therefore the margin might be lower. When the lender's risk appetite increases, you would think that the markup also will go down. Some borrowers might want to move to a fixed rate just because they expect to spend the rest of their lives in a particular location, and they want to insure themselves against interest rate risk. Arden, which is a colleague of mine, basically thinks that in some cases it might be advantageous for the borrower to change from a coffee to an arm. And we have seen on the index that sometimes the arms are more expensive, sometimes the coffees are more expensive. I have a couple more minutes. We'll take a few minutes from now. So this is Arden's Corner. Basically, one of the advantages of working at the Philly Fed is that we have some old-timers with us. So, but the advantage of that is that I had no idea that coffee mortgages existed, but then Arden actually, gave me a very good historical perspective on it because he used to work at the San Francisco Home Loan Bank. So I didn't want to take credit for his comments, so these are some of his comments.
To discuss.
The first one is about the arm. The second one is about basically you cannot refinance at your average coffee rate. The third one is that, again, the average cost of funding, which is not necessarily the cost of funding of a particular bank. So I think Arden has some concerns about your claim that hedging won't be necessary. He still thinks that, and in fact, he claims that when he was at the San Francisco Fed, he did some hedges with coffees, and you might want to talk to him about that. So, Section 3, fair share of default risk, appropriate incentives to underwrite mortgages, and mitigate mortgage disclosure. So, why do we need a government intervention? Okay. This needs to be clarified. Okay. The government is going to impose this G fee. Okay. So if there is some kind of externality that we are trying to correct, why can't we just tax risky loans? And this is where the unrealistic part of my comments from a policy perspective may be, but why is a G fee better than a tax? Okay, a tax might be more targeted than a G fee. There might be some free riding too. I mean, these people that insure this market are basically reducing the risk of the systemic risk, but there might be mortgages that don't participate in the program, so there might be some free riding. I think that the authors need to clarify what they mean by mitigate mortgage foreclosure, because clearly there is loss sharing, but they need to do a little bit of a better job at explaining what the incentives are for underwater borrowers that are considering default. Okay. Now, we also need to keep in mind in terms of mortgage standards, the government already can set mortgage standards. So why is it this proposal better than that? I'm not going to go through section 4, basically. But basically, just to finalize, we have government intervention, we have less, we have things in the middle. So in the case of government intervention, you can end up with the stairs to nowhere. And in the case of fair, you can end up with irrational exuberance, like the case of New Orleans pharmacy selling liquor.
All right, thanks, Jose. I think this last paper illustrates the complexity of regulating consumer credit.
So I think it's kind of late for lunch. No response?
So I think it's really neat to actually go back and look at the LPS data and see what copycats did over the crisis. I think it'd be interesting to look at whether they actually had lower default rates as people's payments went down. Given the results I've seen on ARMS, it suggests that there is a positive effect on the reduction in default rates when people's interest rate payments is reduced. I'm not so sure that the distribution of copies across banks is all that important. And I think one of the reasons why it isn't is that just a small handful of originators actually produce almost all the mortgages in the United States. Top 10, 30% or more of the mortgages are originated by the top 10. And that's not even rolling up to the parent holding company. So when you look at who originates the mortgages, it's their cost of funds that matters, and it's predominantly the large banks. So when you looked across the different pictures, what you see is that the large banks really drive the cost of funds in the United States. So I think structure does matter. Who originates the mortgages matters. And if you can match to their cost of funding, you can greatly reduce the need to actually do a lot of the hedging in mortgage markets. And it's really quite costly when you look at the past 30 years. Yeah, interest rates were reduced over the last 30 years. Some of us would think that's a good thing. It costs less to own a home. But that's the data we have. So we will definitely go back and search and see what happened to the copies in the LPS data. And, in terms of, do we need government backing? I think that there is a systemic component to housing. You see it during the Great Depression. You see it during the Great Recession. You see it in the early 90s, where there's just too much lending and everybody suffers defaults at the same time. And there's this problem of coordinating that I think a lot of people have focused on in this conference, where there's foreclosures happening, there's all kinds of things happening, and that effect is actually much higher costs on everyone. And that's why we have things like HARP and HAMP and all the programs that the government has. The government owns the tail risk in the housing market. It always steps in as long as everybody's going down at the same time. So it happened during the recent crisis. It happened during the Great Depression. So that's why we think there's a market failure there. Thank you. And thanks very much to Jose. He did a really great job going through a lot of data in a short period of time.
Break for lunch. Okay, so I guess we'll break for lunch until 2:30. What's the instructions?